I made $10 million. It's okay for me to pay $4 million to the government. That is not true. Break the myth that the more money you make, the more taxes you pay. Government doesn't grow the economy. Sending $4 million to the IRS or the Department of Treasury does not grow the economy. In a perfect world, it would, and even a country understands that. That's why we have these incentives in the tax code. But enough of that. We are taxpayer advocates where we help you reduce your taxes. Most CPAs aren't like that.
They're preventing them from gaining wealth because we want to focus on the proactive piece, because planning doesn't stop just because you have to file the tax return.
Welcome back to the Hidden Money Podcast. This is our first episode of season 4 and we are excited. We're changing things up a little bit, but before we get started on today's topic, let us just remind you a little bit about who Kevin and I are, what the Hidden Money Podcast is all about, and why our company, Revo Taxpayer Advocacy, is not a normal tax CPA firm. We don't consider ourselves CPAs, even though Kevin and I and most of our employees are CPAs. We are taxpayer advocates. As a matter of fact, a dumb rule exists by the AICPA and the Texas Board of Public Accounts that says, unless you have your partner's name in the name of your company, one of your partners, you can't be a licensed CPA firm. We argued back and forth with the board. Come on. We don't want to be thought of as your average CPAs because, quite honestly, the CPA firms in this world have been underserving, way underserving the taxpayers of this country, and we want to change that. We don't want you to see us as a CPA firm. We are taxpayer advocates where we help you reduce your taxes. Most CPAs aren't like that, are they?
No, I think you and I come across this a lot, to where we have clients that come in and CPAs tell them no all the time. They're just like, no, can't do that, no. And we rarely say no or you can't do that, because there's typically in tax law there's a way around things. Now, not always, legal. But yeah, there's legal ways around everything, because it lies in the details of your specific case, and you have to know your client specifically and their situation, their income and everything, and develop a customized tax plan, which a lot of CPAs don't do. No. And so they just say, well, this doesn't work for the majority of my client base, so it's not going to work for you. That's what I hear a lot from people coming in, and I'm like, it's just not true at all.
The other thing I hear, and a major complaint I hear from new clients and prospects, is my CPA doesn't offer me any way to lower my tax. My CPA just asks for my documents. They just ask for my documents. I don't hear from them until January after the tax year is passed, and then they give me a tax return and I don't hear from them again. That is underserving the world. The tax code is written on purpose, chock full of incentives that if you follow these things, you get tax benefits. And the reason that's in there, it's not cheating. It is in there to incentivize business owners, individuals, to put capital into specific areas that will help our economy. And that's why those incentives exist. They're not loopholes, they're incentives. Yeah. And most CPAs don't study that. 99.8% of the tax code, give me a couple point, maybe it's 99.6, I don't know. But 99+% of the tax code has nothing to do with the assessment of taxes. That remaining amount, less than 1%, if you read all of the IRC and all of the Treasury regulations, has nothing to do with the levying of tax. The problem is most CPAs, that's what they study. They focus on the levying of tax, that 1% or less of the tax law out there. And that's how we're taught in school. That's what we're tested on the CPA exam. Do you know this part? The remaining amount is where the gold exists. That is where the value exists in the Internal Revenue Code. That's where the incentives are. If you're CPA, and most of them aren't, so most likely he isn't, if you've got one that's telling you, hey, here's the incentives, let's do this year so next year your taxes look better, then you've got a tax planner, but most aren't, and that's what makes us different.
Yeah, and I think some CPAs, they're, if you think about it, they're preventing our clients from even keeping their money. They're preventing them from gaining wealth because, and they may not even be doing it on purpose.
Most aren't.
They're just, because I'm guilty of this too in my career. Early on in my career, I would really be focused on brass tacks. Hey, I have in busy season, I do have 200 clients have to file a tax return by April. That is a real thing. Like you do have to file tax returns. But that's why we wanted to change and flip this on its head, is saying, hey, our firm is going to prep taxes. But even in Q1 of every tax year, we want to focus on the proactive piece, because planning doesn't stop just because you have to actually file the tax return.
I know.
So you have to actually continue the conversation with our clients, and that's the point. That's why we want to do this podcast, is to get the word out saying, hey, yeah, it might be February, and the tax planning may not be on your mind because you're like, I'll deal with that in Q3 or Q4. Well, we could start now, and there's no reason not to.
We should start now. The problem is all those incentives in the tax code, they require you to do stuff, to take action during the tax year. And a lot of the great opportunities take more than a few months to do. So if you wait until Q4 or December, God forbid, to try to tax plan, your opportunities went from this in January to this in December. You can still do something in December. You know, I have the same story as you. In my career, 200, 300 tax returns we had to prepare by April 15th. There was never enough capacity. People were quitting, you know, there was never enough people to do it. So we were working 80, 90-hour weeks just to prepare those tax returns. We didn't have time to call our clients and talk to them. And then extensions happened, and a bunch more people quit because they were overworked. And we still don't have time to talk with our clients. And every CPA firm I went to, they advertise themselves. We are proactive tax planners. Let us be your proactive tax planning partner. There was no proactivity. It was all compliance focused. We couldn't be proactive because we were catching up, and we could barely catch up. And a lot of times we didn't. That's the firm you and I created is different. We are overstaffed. We have enough capacity. Our team doesn't have to work more than 50 hours a week during tax season, which is unheard of in the industry.
Keep them fresh, and it keeps errors down too.
Yes.
And I think probably our staff is probably preparing 70 to 100 maybe.
Yeah.
In busy season, where I was used to 200, 300, somewhere in that range.
So instead of just plugging numbers into boxes, they can think about
and
they
can pick out now. They can sometimes pull out some tax savings during the prep process.
Yes.
I mean, there's some things like retirement that you could do it, you know, after the calendar turns, that you can actually contribute to a SEP. You could contribute to a defined benefit cash balance plan or something like that, and reduce your taxes.
But those opportunities instead
But
of
now
like
you've
this,
gone from that to
now
this,
like
and now
this.
it's even shorter than when it was in December.
Right.
And so, you know, we prep a heck of a return. Like I'm really impressed, and this is just honest in my heart. I feel like we prep the best return in any firm I've worked for.
Agreed.
Any other return that comes in our door from a new client, I'm like, you can pick out errors, and I'm sure we're not
perfect, no.
Yeah, but we have quality control processes in place for a
Yeah.
specific reason, and it's such a big benefit to have a properly prepared return, but also simultaneously not losing track of the current year.
Kevin, I just realized we've spent about 7 minutes already talking about our firm, and that's not what this podcast is about.
I'm excited
so
about it.
Forgive us. We love what we've built. We're proud of it. We're enjoying how God has built up our firm to be so different from others. But enough of that. You don't need to be our clients to learn something here. So today's episode is trying to break the myth that the more money you make, the more taxes you pay. CPAs say that all the time. I think most people believe that.
It is what it is what we hear.
Yeah.
Hey, it is what it is. I made so much money, and what can I do? You know, I do some very small tax planning throughout the year. We see that a lot. It's like, well, I paid my kids, and I maxed out my retirement, and I'm like, cool. How much money did you make? Oh, about $10 million. I'm like, oh, you moved the needle literally probably like a tick on your, and it helps. But what we want to do is take that needle and throttle it the other way and say, I made $1 million and I'm taxed on 80,000 or 100,000 of it or 200,000. Like, we want to drastically impact lives through tax mitigation.
But sometimes you hear from clients, or from new clients, generally not our continuing clients, but you hear from new clients, well, I made $10 million. It's okay for me to pay $4 million to the government. Really?
Yeah,
like,
no.
That's
a weird mindset, and we actually, you mentioned that, you know, our clients still have trouble with this.
Yeah.
This actually came up in the last
November,
December. We have a client that they're made $11 million of net income in their business.
So far, their biggest year.
Biggest year they've ever had. And they've been clients of ours for 10 years.
Yeah, a long time.
So they're not new to the game.
No.
But what we see a lot, and we tried, like I reached out, I think in like October, I reached it out again in November, and then I was like, I tagged you in. I go, Mike, I go, tag, I need, get them on get them. They're not responding to me. And then so Mike jumped in and we got a meeting with them in like December.
Yes.
And
but
so
there were still opportunities in December.
There were
not
still things we could do
as when we first reached
and we
out.
could significantly do some changes in December for them.
Yes.
And so we walked through the numbers. We walked through the scenario saying, here, okay, if you sit tight and do nothing, you owe like $4 million in tax. And they've already paid the taxes throughout the year. They paid their estimated payments. And so they've already remitted at least three and a half to the government.
And they were going to have to pay another $1 million or $800,000
in Q4. And so we're like, hey, instead of remitting the $1 million to the government in Q4, why don't we do these strategies and it's going to save you $2 million in tax.
And you'll get $1 million refund.
And
we could have gotten them the entire refund. I mean, of all.
So what would you talk like? How do we get into that?
I think their mindset, because those are smart people and they're good people. I think the mindset. I'm only guessing. I haven't been able to get them to answer the phone. One, they're busy. To make $11 million in their company.
And they're not a huge company either.
And their company made, I think, like $4 million the year before and only like 1.5 the year before. So they're growing, they're working hard. They are thinking, I don't have time to focus on this tax stuff. So it's worth the $4 million I'm gonna pay to the government. I think they also might think, look, I'm making the most I've ever made before.
Even after tax.
Even after paying $4 million, literally
Still
over
got 7 in the
37% in tax. So it's okay, I'm okay with that. Or I think some people feel guilty about once they're having a big year like that, not paying the full amount of tax that these guys were paying. I think that's terrible stewardship. Just imagine if they would have spent, what would it have taken? In all honesty, let's say we met with them in March, came up with 3-4 strategies to save them. Instead of paying $4 million, drop their tax bill down to $1 million.
It probably would have been about, at that level, probably 6 to 10 hours of consultation, number running, and then execution. So maybe 10 hours, I would say, with just a few specific strategies in this client's
maybe
example.
Like 20 hours if they wanted to double and triple check the due diligence of all the things we were getting them to do, run it by lawyers.
20 hours
20
and saves,
hours.
how much would you say we could have saved them in probably just 20 hours of consultation?
At least 2, probably closer to 3 million.
Yeah.
So instead of paying the government $4 million, they could have paid the government $1 million, maybe $2 million, kept that $2 million. If you still feel guilty, go open a charity, give it to charity, but don't feel guilty. Grow your business, go hire more people, buy some more equipment, grow your business. The reason those incentives exist, they're not loopholes, they're incentives and they exist so we can grow the economy. Government doesn't grow the economy. Sending $4 million to the IRS or the Department of Treasury does not grow the economy. I promise you. In a perfect world it would, but that's not how it works. And even our country understands that. That's why we have these incentives in the tax code. So it just drives me nuts. There's so many ways.
Where else are you going to get paid $100,000 an hour or $200,000 an hour? 20 hours worth of work, and you're going to save a couple million.
And that's what's so hard for us to drive into the minds of some clients like that. They're like, I don't have enough time. I'm working 80 hours a week on my job. Okay, but work 82 hours a week just for another 10 weeks. 82 hours a week. And make $200,000 an hour for each of those additional 2 hours. That would change the needle.
We're shortening that curve. It's not like you have to create tax. We know what the tax strategies are in your business.
Yeah.
The 20 hours is going to be us teaching you what those are, how to implement them, how to do them safely, educating you on the numbers and the bottom line.
And the documentation
it's us
to
doing,
be able
of
to,
the 20 hours that you see to the client, it's probably 50 hours maybe of back end work that we're doing. So we're doing the work, and then it's just education, presentation, and just kind of picking and choosing what strategies I want and what fit with my life.
And a good third to maybe even half of the time the client has to spend is accumulating the documentation so that if they get audited, we can show the IRS it was fine, go away. And we do that with our clients. I mean, we have so many examples. What's another one? I'm trying. There's too many examples of people not waiting or procrastinating until the end.
I mean, without naming names, I think it was upwards around 13, somewhere around there, but we just could not get him on the phone. And we kept going to him and his
I know exactly what you're talking about.
This visit, the administrator,
their CFO, well, their controller. Their controller was with us. They're like, yes, I know. We're tallying up. We're saving these taxes. He's going to owe $4.5, almost $5 million. And the thing is I've had this conversation with him the last couple
years, right?
Yeah, three.
Yeah,
three years.
This is like, it's almost like, hey, it's like an internal joke. It's like, he responds. And we're like, no.
But every time we have this conversation, and we try to start having it in June. This year we started reaching out to him in June. And he responded. I finally started texting him. I hate giving out my cell phone to clients. It's never a good idea, but it just drives me crazy to waste $5 million. You're flushing $5 million down the toilet. I texted him and he said, yes, we definitely want to do tax strategy this year. I texted him a week later. Okay, let's get on the phone. He's like, next week. And so I texted his wife. And she's like, that's all his job. You know, I stay out of that. He didn't answer. I even texted her a month later and said, tell your husband he's flushing over $4 million down the toilet. And I got a message from him a week later. Don't text my wife anymore. But they wouldn't do it. And there was literally, at that point, I presented to his controller. I was like, just tell him this, because she talked to him every day in the office. Tell him these 5 strategies. This is how it works, and this is what it would save. I got a text back that says, I want to do this.
What happened?
I don't understand.
It's mind-boggling how they can come to that conclusion. And I get it. Taxes aren't the most exciting topic.
I think it's also a fear.
But it's a necessary topic, too.
I think unfortunately, I think the IRS, on purpose, has put so much fear in people's heads in our country that if you make more money, you better pay more tax or we're coming after you. And I think maybe there was some fear because this guy had also gotten audited and had some trouble with the IRS right before he came to us, and we helped him get out of that. And I think there was still that fear, and he's like, man, again, I'm doing fine. We're making all this money. Let's just pay him. And that's another false premise that we hear all the time. If I pay the government a lot of money, they're not going to audit me.
Wrong.
Baloney. If I don't pay them a lot of money, they're going to audit me. Baloney. They might audit you if you pay them a lot, not audit you if you don't pay them much, as long as you're doing legal tax strategies. But unfortunately, once more, I'm going to keep working on them. I like this guy. They're good people.
They are.
We don't want them to waste that money anymore.
And it's really not just how much you pay them. It's your income. It's a number of drivers. It could just be lotto chance, too, that you get pulled for audit.
But this doesn't just apply to $10 million makers. We've got, think of someone.
$500,000 range, too.
You had this client that was doing a 1031 exchange. I remember this. And they were going to buy a short-term rental, and we coached them through the short-term rental loophole. Mm-hmm. And you told them exactly what to do. Mm-hmm. The client, before he called Kevin back, what he had to do was pull some money out of his retirement account, which is going to charge income tax plus 10% penalty because he wasn't retirement age. But if he'd have done just enough to make the down payment and financed it back when rates were like 4.25, mm-hmm. all of that tax, all of that penalties would have been eaten away with a bonus depreciation and a whole lot more. It would have basically given him his whole down payment back and covered all the tax on it. The client decided, well, if I don't finance this and I just pull out the whole amount from my retirement account, and this guy was making like what, $300-400 a year? Yeah. If I just pull it all out and pay cash, I'm going to be good to do this, and I'm 1031ing and blah, blah, blah. Well, it so happens when you 1031 and you pay down debt from your first property to your replacement property.
That's a benefit.
That's called boot. He liked it, felt good, but the government said, guess what? That doesn't qualify for 1031, so that's taxable. So instead of him having a bunch of savings, he paid a 10% penalty on $700,000. Yeah, I think his tax bill that year was like $238,000 or something.
And we had so many conversations beforehand too. It's just he changed the plan without circling back.
Yes.
And so Yeah, he wanted to get his money out of retirement. He's like, my retirement account's getting burned. He's like, I don't want, Wall Street's messing me up. I want to go and I want to transition my money from my retirement account into a hard asset that I can control
and do. We had a plan to do this over 4 years.
And we had the plan. I was like, okay. And I let him know, I was like, you're not of retirement age. You're going to get hit with penalties and tax. But if we tax plan if you buy the right property and it depreciates well, you're not going to feel the burden of the tax, and you've moved your money over, even though we can't eat away at the penalty. But anyway, at the end of we got the numbers kind of where they needed to be, and he was okay with them. And I'm not a big fan of pulling money out of your retirement account, but this is what he wanted to do. And we did a tax plan for what the client wanted. But at the end of the day, he changed it. I was like, he's like, well, I'm just going to pull a little bit more out of my retirement account and pay all cash on this property. And I'm like, you've generated more income from the retirement. 2, now we have mortgage boot. And he was just, I guess I should have called. Yeah, you should. If you veer from the tax plans we make, please, especially if it's a material thing like that, because there's so many small details in the tax code, like mortgage boot, that people just think, if I do a 1031 and I get a QI in there, qualified intermediary, and they do the deal, and it's all deferred.
Yeah, we've had so many new clients come in and said, I did a 1031 last year, and their QI messed it up, and they had taxable income, and they were shocked. They should have worked, and they said their CPA blessed it. I don't think the CPA read the documentation, and they didn't get 1031. It was all taxable. We've had other clients or new clients come in, and like with the Opportunity Zone, I remember this one client came in, new client, I didn't hear from him until like the end of December. No, it was January, beginning of January, and he's like, I did this. My CPA told me to do this Opportunity Zone investment because I had a $400,000 gain on a sale of stock or something. It was stock. And as long as I put it in this Opportunity Zone fund, it wouldn't be taxable. The CPA failed to tell him you have 180 days to put in the Opportunity Zone fund. You know how long he waited?
How? 187
days. It was all taxable. And he didn't have the money to pay the tax because he invested it in this fund. You gotta have a good strategist that talks with you, tells you your plan point by point, step by step, gives you a written outline, a checklist, and someone that's gonna answer you and talk to you every step of the way. And unless you are absolutely certain that you're following the instructions, don't do it. And if your CPA isn't giving you those, consider someone else.
And that's the solution to all of this. So if any of these stories resonate with you, we don't need you to know all the tax code. That's our job. You just need to pick up a phone, shoot an email, go to our website. You can go to revotaxpayer.com. It just starts there. Just have a conversation with me, Mike, someone on our team, and just open the door to something possibly new. That's the solution, like you hit on it. It's regular, continuous communication, thoughtful, intentional planning throughout the year. And it doesn't have to be a drag. 1 hour a month, 2 hours a quarter. We'll work with anything, but we can make a 1 hour meeting so productive and so much ROI. So check us out on our website. If any of these stories resonate with you, you don't have to be one of these stories. You could be something different, something better, and you can see the fruit of planning this year. So check us out at revotaxpayer.com. Like, subscribe, and follow us on all socials if you so see it. If you find this information useful, just do us a favor. Follow us, like us, shoot a comment. We'll check the YouTube comments. We'll if you have questions, we'll get back to you.
But share it with a friend. Help us change the paradigm out there that you're supposed to pay more in tax. That is not true. Help a friend. Shoot them our podcast. And if you're wondering what kind of strategies we're talking about, we've got many podcasts where we go over different ones and we release a new one each week. But there are so many more strategies we've yet to do a podcast on. So check us out.